Thank you all for coming today for my talk on energy. And the best part about coming to this event is I came in saying I'm going to talk about the new world order, 2020s and beyond. And somebody here told me the next 24 hours and beyond, given where oil is, and we want to have a very clear and pointed view of where we are and where we are headed. And I'll try to give you that, right? So let's spend 5 minutes talking about the very near term because it's on everybody's mind. And I can give you my own thinking on this, especially having called for a 72 Brent literally in the first half of January. We saw a lot of the drivers, bullish drivers, to drive it up to 72. But from this point on, I think there's a stall and maybe a slow reversal. I'll walk you through. Let's see what got us here. What are the things that will cap the potential rise with the near-term, bullish factors and fears around Iran, and sort of what are the ways in which not just are we making the call, but the things to watch for. The way do you mark to market every single day around your assumptions to know that indeed, you're getting that particular price path. So why did we call for 72 Brent back in January? Basically, we had seen what cost us to go so low in December, right? So basically, what happened last year was you had, of course, tight balances, but you had the spec position go to full manic levels. Literally, we had 1 billion barrels of net managed money spec length. CTAs, commodity trading advisors, these are basically robots that trade on trend following momentum signals, were at max levels. And you had, right after getting into a manic phase, assuming that there will be no Iran sanction waivers, there were not just waivers, but Saudi had already ramped up supply, Saudis and Russians and everyone in anticipation. And the very act that the pendulum was at one extreme got you swinging to the other extreme, right? When CTAs are at max position and you lose momentum, the price starts to turn, and literally you start to get the bearish market signals to drive it lower. We came into January, and the first thing that struck me was every factor was starting to look bullish, right? You saw that as early as December, Saudi pulled back sailings. The market was getting much tighter. When we projected our own supply-demand balances for February, we had massive draws, even in a season that typically builds. There's one light that I always use for demand, which is, people don't normally use it. It's the ESPO premium to dated Brent. ESPO is the Eastern Siberian pipeline that's used to fill China, right? So when Chinese buyers pay a significant premium to even dated Brent, you know that you're in manic phase. In fact, that helped when I met many of you back last year itself. It kind of helped me call both the manic phase and the depressive phase. We saw ESPO premiums also pick back up sharply in January. And look, there were very clear signs of Saudi supply discipline. US rig counts did show more discipline. High-yield rigs fell. Only the majors were still drilling in Permian after the sell-off in November, December. And it was fairly easy. And the CTAs, right, the commodity trading advisors were at max short levels. And we had done some analysis that said whether prices are up or down, they have to cover. They beached themselves like a whale. And it was fairly, I won't say easy, but it gave enough conviction to go out and make a bold call that we hit 72 Brent within the next 2-3 months. Now that we are here, where do we think this goes? I would say, and I'll try to put my neck on the line as precisely as possible, I don't think we go much over this level. I think my sense is last night was the high. And the reason is this, right? So there are 3 reasons I will point to, and I will also make my reasoning very clear such that you can hold the assumptions and my comments accountable literally on a daily basis. So basically our call, even on the Iran news, was every sign was given both by the US administration and Saudi that there will be a backfill. And our own take, right? I've done detailed analysis. I'll try to try to be as precise as I can. I think that 800,000 barrels can be backfilled of the 1 million Iran supply drop literally in the next 2 months. How do I come up with this 800,000 number? I expect Saudi to be between 300,000 to 500,000. We had said this, in fact, a few days ago. Today, you got the Saudi news saying that they will backfill about 300,000, basically go from 9.7 million barrels per day to 10. We think that fields like Gawar and Manifa are literally ready to go. I think they're coming out of maintenance in Manifa, and the ability of Gawar, 300 to 500,000 won't be a problem at all to backfill in terms of the next month or two. Same with Abu Dhabi. We've identified about 150 to 200,000 barrels per day that can come back online very easily in Abu Dhabi in the next month or two. On top of it, even others like Kuwait and in the case of Iraq, we've seen that they are actually below their ability. Unlike in the past, they've really done a great work in southern Iraq in terms of being able to ramp up. That can come online. And in Russia, which was anyway a reluctant cutter of OPEC supply, we think they can bring back 2,000 very, very easily. And they've signaled it, right? They've been talking about the June OPEC meeting. So our call here is we do not go into a deep manic or a deep depressive phase for oil, right? So we are here at 75. I think the recent events perhaps put a higher floor, like 69 on Brent, but I don't see us going much further than this, whether you're talking end of this month or end of the quarter. In terms of our own view for the next quarter, I still think you possibly grind down a little bit closer to a 70 or a 68 to 72 type range. And in the fourth quarter, I think that's when you start to go into more moderate mid-60 price levels. Basically, we want to put, this is primarily our call. Again, in terms of what can go wrong, people say you're making all these forecasts. What is the one thing that can make you go really wrong? And that's true. If you have a military conflict in the Gulf of Hormuz, that's when all bets are off. And how do I know I'm right? Literally, I would make the call that in the next, like we did even 2 days ago, I think in the next 3 to 5 days, not just the Saudi 300 kbbd, I expect that you will hear similar announcements potentially from the others, from the Abu Dhabi and Kuwait. And I wouldn't be surprised if you started getting comments from Novak of Russia as well. In terms of the Permian Basin debottlenecking, that's more post-July. Post-July, I think there's very easy 300, 400,000 that can come from the US shale, just from the new pipelines they've built to debottleneck the Permian Basin. So hopefully I've addressed your near-term concerns. Yes, oil has a slightly higher floor, but I don't think you're going a deep manic price much higher from here. Having addressed this, let's talk about 2020s and beyond. And to be clear, it's not like I'm trying to give good news. I actually had given this presentation in the Middle East widely to many of the sovereigns there, actually telling them that, look, you've had a good 1-2 years like we had forecast, but now is the time to hear about the long-term bad news for them, which is actually, as a backdrop, basically what I would call the drivers of a secular bear market starting in the 2020s. So let's get past the... Okay. So I will basically try to go here. There are basically 3 factors, right? There are 3 factors that matter for 2020s and beyond. If you ask me, why am I fairly confident of a structural bear market? First and foremost, LNG. Yes, LNG, people think of it as gas supply, but essentially when you do analysis, a gas supply of that quantum also comes with a huge associated supply of LPG, ethane, condensate, which effectively are shadow supply for oil. And even from the demand destruction front, every unit of LPG displaces 0.4 units of fuel oil and 0.6 units of coal and others, which again, right, where the mining is very diesel intensive. So there's indirect demand destruction plus shadow supply coming from LNG, and we have a massive surge in LNG supply. That's the first factor. Secondly, and this is possibly geopolitically the most important call, and we have made those calls, right? We did call in 2014 for the collapse of OPEC, which is why we made a call of 40 when oil was in the hundreds, and same way in the reformation of what I call ROPEC, Russian OPEC, early in Feb 2016, that led to the rebound. Our own call now for OPEC is it is going to get very fragmented, potentially as early as end of this year or next year. Depends literally as to when you have regime change in Venezuela. I'll go into more details there. We think, just as everybody is very complacent that the Russian OPEC cartel is done, it's strong, there will be countervailing forces. especially if you have regime change in Venezuela. And finally, a lot of modeling work we've done on EVs. The future of mobility shows us there's a secular decline in gasoline demand growth that you can't get away from. Very quickly, this is our gasoline demand forecast. Our own forecast, we've very detailedly modeled it out, right? We've said, hey, let's model VMTs, let's model energy efficiencies from the internal combustion engines themselves, model in the scrappage of getting more energy efficient vehicles from the old models, as well as EVs. And this is extremely important. We believe as early as 2021, granted EV penetration is just taking off, but from a rate of growth standpoint, we think it'll start to feel like zero from 2021. You have a stall in the growth rate of gasoline, and in the 2030s, you actually start to see a collapse in the gasoline demand itself, right? So the stall in the growth rate for the next decade and a collapse. And why is it nonlinear? It actually comes out of the math. Your EV penetration takes off exponentially, and in the chart, I've also shown our original forecast when we took it to the Middle East in 2017 versus now. In fact, we've increased our EV acceleration rate based on a lot of trends we are seeing, both in terms of investments by Volkswagen and the like for modular manufacturing, cost efficiency improvements by battery makers. So that's real. So you have a demand picture that's staring you in the face, and I think that's actually well understood by many of the GCC countries as well. Oil producers, members of OPEC cartel, that you are facing a big decline in gasoline demand coming online. Diesel demand per unit GDP, I'm not going to talk too much about IMO 2020. I agree near term, you can get a diesel catalyst until you solve the HSFO, high sulfur fuel oil assumption. But per unit GDP, we are consuming less oil in the world, right? Things are more efficient. We don't carry as much inventory. Things are lightweighted. So per unit GDP, diesel intensity has been falling literally over the last several decades, and we expect that to continue on. This is the dual hit to balances from LNG, a very, very important point. Look, we have about 133 million tons per annum of LNG coming by 2025, and just the indirect impact of it, right, in terms of squeezing out fuel oil, in terms of squeezing out coal and therefore diesel demand for coal mining, and in terms of associated, the LPG that comes with it, the ethane condensate that comes from it, and the naphtha you kick out of the petchem stack, that's 2 million barrels per day. So it's really big. And we will go through when we talk about neutralization of OPEC. You take all this, and I will walk you through what people like Saudi would see staring on their face. One more point on the LNG supply, and this is very important for people from India as well. People get asked, Sriram, how are you so confident on LNG supply? What about time to FID? What about Capex? They've all improved. Time to FID has come by half, like you see on that chart there. 3 years compared to 6 years, from FID to first gas. Equally, what is really stunning, and you see in the end of the chart there, is the surge from US or North American LNG coming. And in terms of how feasible it is, I'll give you a simple idea. When the Australian LNG projects were built, it was $2,000 per ton of liquefaction Capex. Anadarko in Mozambique is talking about what, $650 to $700 per ton for the Mozambique. And in US, most of them are around $750 per ton, and you have some new venture companies, not proven yet, but talking as low as $500 per ton. So this is a significant challenge that one has to deal with. But equally, it's a big windfall for energy consumers and LNG consumers in Asia like India. But again, this is something that anyone looking at oil balances has to contend with. There will be a big surge in LNG supply from now through 2025. And in terms of power generation, there's plenty of demand in China. There's no issue with fuel oil substitution. So we don't think that there's any major demand hurdle that creates any problem in terms of absorbing this incremental supply. Now for the most fun part, neutralization of OPEC. We've always enjoyed making the big OPEC calls, both the dismantling in 2014 and the regrouping as ROPEC in 2016. But this one's a bit more nuanced, and I'm going to introduce two terms here. Monroe-PEC is something term we've been using, and I'm going to talk a little bit about Venezuela. See, why was all this possible? Why was OPEC even able to stay alive as a cartel over the last decade? Some interruptions, but broadly stay alive as a cartel. The reason is Saudi and GCC didn't need to make as much relative concessions because Venezuelan supply was declining. It kept declining, and there really was not, there was room. Yes, the cartel in aggregate might have lost market share, but the GCC countries or Saudi dominant players did not lose market share. However, it's a very different picture if there's regime change in Venezuela, which is quite likely, looking at the actions of US governments and most European countries here. Our main call here is, from the moment Maduro is on a plane, 6 months from then, what should happen? Number one, you possibly have an IMF package. At the same time, the country cannot support a big debt. It needs a small base debt. So they basically incentivize by having a value recovery component based on future production for most of the creditor nations. This has been done in the past. This was in fact done with Mozambique last year, the VRI. It's called a value recovery instrument. And in a situation like that, you cannot go along with OPEC cuts. And equally as a nation, you want that because it aligns the incentives of creditor and debtor nations, right? To be able to provide all the diluent so that Venezuelan oil can go out. On top of this, I like to point out to people, my biggest GDP call globally is Guyana, where I think the GDP will increase by 1,000% in the next 7 years, all based on one oil field, right? It's literally a new Oman by 2023 and a new Kuwait by 2025-26. It's almost like Qatar, and I'll go through the details. It's just an amazing oil find with economics that far trumps shale. So you put that together, and what happens? Basically, you go back to North America being 33% of global supply, enormous geopolitical influence. And I use the phrase Monroe-PEC for one reason. For those of you who are familiar with Western Hemisphere, right? Monroe Doctrine was the key doctrine that US used to dominate the Western Hemisphere, right? James Monroe, the fifth president, basically said Europe has no business interfering in the Americas. And different corollaries of this affected the history of Latin America, not just in oil, but in everything. In fact, the border of Venezuela and Guyana was literally developed by the US Secretary of State, Olney Corollary. He named the Monroe Doctrine, who helped even determine that border. So across the Western Hemisphere, with Guyana, Venezuela, and US, the NGLs, the shale-associated natural gas liquids, plus oil, going to 21 million barrels per day, OPEC's hands are tied. I think people are facing this. They got a near-term reprieve, but everybody is watching, the infrastructure coming up in the Permian Basin and elsewhere that creates this enormous supply surge. And I keep using the phrase Monroe-PEC because what has happened in 2016 is you had a unique situation where Russia and Saudi mutual interests aligned, and it made sense to cut OPEC and cut supply for OPEC, and they didn't really give up as much because Venezuelan and Libyan supplies were declining elsewhere. So even though aggregate there was an OPEC cut, they themselves didn't give up in relative terms as much. But in Monroe-PEC, once you look in the 2020s, it's a very, very different story. In fact, we are projecting 7.5 million barrels per day growth in the next 7 years in North America. US, Venezuela, Guyana, Mexico, and Saudi, UAE, Russia cannot do more than 2.7 in the sense that without seriously disrupting balances. Now the question, I will skip some of this for this particular talk. I've saved this more for the Middle East. People said, how can Venezuelan supply rebound? I'll say it in three phases. There were three big mistakes Maduro made, and I don't think the new regime would make it. They have top-notch people talking about, people like Luis Guisti and others have been talking about joining a future Guaido administration in an oil capacity. And basically the mistakes they made, the neglect of Maracaibo Basin, the complete delusion that oil can be over 100, which Chavez relied on for his social programs, all those mistakes are unlikely to be repeated by a new regime. So that's the point I want to drive home very hard. Second point, we've done fairly detailed work on Venezuelan supply recovery. Today, it might not matter to you, but the day Maduro is on a flight out and there's a potential regime change, everyone will be looking at this. This will be the animal spirits that drive the oil market. Everyone, including the World Bank, will be looking at it, right? How quickly can the supply come back up? Can we have a restructuring package for the country? What should be the base debt component? What should be the VRI value recovery instrument component? And in that regime, they can't afford to go with any production cuts. You will be talking production increases for the country. Very quickly on Guyana, this is just of interest because as a kid, I just remember it for cricket matches played in Georgetown. But it's amazing that this is the big call to take away here, just on the side interest, global call to take away is this is the country that's going to see the highest increase in GDP over the next 5 to 6 years, almost 1,000% increase. In fact, I was taking it. The GDP per capita is $4,000, right? The single oil well Lisa revenues, if you monetize it, is $50,000 per capita. That's the size of the find. So this is going to emerge, given that as a group you also care about Indian diaspora, I think it just warrants taking a look at this. The last time you saw something like this was Qatar, right? With the ExxonMobil LNG projects, you saw this country was going to shoot up in the global GDP markets. And Guyana is emerging as the Qatar of oil, a very, very small country with possibly one of the best oil resources. And I'm an oil and gas guy. People have asked me, how does it compare to shale? Far, far better. I think at $30, they're extremely economical, for $30 per barrel oil. And the reservoir quality is unbelievable. This is possibly the greatest find, I would say, of the decade. Now, when you add those numbers in a sentence, there's only one cell I'll highlight. I put Saudi Arabia and put 10.5 in red. That's, again, a big call, is once you're in this new paradigm, right? Once you've got potential regime change in Venezuela, OPEC can look 5 years out, even with demand growth of 1 million barrels per day, which is reasonable for the next 5 years. You're not going to see 1.4, 1.5 like earlier. One is a more reasonable assumption. There's just no wiggle room for Saudi and for others as well. But UAE and all have some fields ready to go. So you put it all together, we think you're cut in a structural bear market. The limit of the bear market can be managed by OPEC, but I think we very strongly in the bear market. I personally have lived through this. After my PhD in aerospace engineering in 1997 from Georgia Tech, instead of going to work for FAA or NASA, I said I'm going to work for Schlumberger and develop fracking technologies, cool stuff, solid fluid mechanics, coupled problems, all very, very exciting stuff. And then I basically joined in 97. Things looked very good. And at that time was exactly when Saudi and Venezuela, at that time Luis Guisti, who's now making the rounds in Washington, potentially to be in the next administration, was the CEO of PDVSA. He did a brilliant job, right? Increased supply, did joint ventures with the Western countries. It was called La Apertura, in Spanish, the opening up. Amazing job. And just his conflict with the Saudis alone made oil price go from $14 a barrel to $7 a barrel as low within 1 year. So this tensions, remember, this whole last 7 to 10 years have been an aberration in terms of Venezuela and Saudi being in the same page because Chavez needed high prices for his social programs. But that's not the norm. In any other regime, you go back to the old paradigm where there was tensions between the Western Hemisphere and the Middle East. So this, to me, is going to be, yes, I hopefully have addressed your near-term questions on oil, but this is a medium-term factor, long-term factor, and I know people can say anything as long-term. I try to be as precise as I can. So 6 months after Maduro, if and when Maduro gets on a flight, you're staring at that oil outlook. The question becomes, do you gradually moderate Saudi and Venezuela because Saudi kind of needs higher prices, at least till they get more bonds issued out of Aramco, as Fali had mentioned, kind of manage it at that level and manage a slow decline, or a complete confrontation like 97, 98 paradigm, which could be a dismantling of OPEC. My take is still for a gradual neutralization. So as much as I will try and make as precise a call for the next month, 2 months, if you held a gun to my head and said, what's your 3-year, 4-year oil price outlook For Brent, it's actually in the 50s. It's not even in the 60s because of this paradigm. So. And finally, the Evi Megatrend. This is for real, the EV penetration. And the main point I want to make here is companies are actually putting money where their mouth is. Look at Volkswagen, right? Look at the modular manufacturing. They are building modules, right? And when we talk to battery makers in China and elsewhere, Korean, look, really 4 players, right? CATL, you talk to LG Chem, you talk to Samsung, you talk to Panasonic. Kind of the same story, right? There's more confidence because automakers are actually investing in modular manufacturing, putting the Capex to build EVs. And in terms of performance, let's leave out the new EV models. Just in terms of performance and price, let's look at the high end, whether it's the Porsche Taycan, whether it's the Jaguar I-Pace versus the Audi, better performance, better price already, right? And you're headed to further declines in battery costs. And very importantly, high end is where margins are made in the auto industry, and that subsidizes the lower end over time, right? So you will see increasing penetration, but at the very high end, if the battle is won, then the battle is already won in terms of EV penetration. And that's why we are confident with our overall projections, that if the most profitable models become the high-end EVs, there's no reason low-end EVs won't follow. So there's significant, people ask the question, are they already cost-effective? They are in many places, right? As you know, in China, for instance, you don't get a license plate in Beijing if it's not an EV. In Shanghai, you're paid, something like 60,000 renminbi if it's not an electric vehicle. There are all these penalties and subsidies that work. But the main point is, even without the subsidies, when we've done fairly detailed work, it works. Because what has happened, in batteries, 2 things have happened, right? People use the term NMC 622, which is obviously 60% nickel, 20% manganese and cobalt. They're moving towards 811. So people are using less and less cobalt, and also they're doing much better recycling of cobalt and lithium, that the battery costs are in secular decline. So, and that is the main source for the car, right? It's not, you don't have a detailed powertrain like you have in conventional internal combustion engine ICE vehicles. So the battery costs are coming down sharply, and even with subsidy removal, we think by 2020, EVs should be cheaper than they are now. And at the same time, you have more regulation on internal combustion engines that gets more expensive. So basically, you are headed to significant EV penetration. The main issue is the charging outlets, and people are still solving it. This is the big unknown for the EV assumption, right? Basically, the world has to go to a smartphone model from a retail filling station model, right? Because to fill an EV takes significant time, even with high charge density. So you need huge charging infrastructure for people to be able to charge it. Again, a lot of our EV penetration numbers are driven by China, EU, and US. China is already making the moves. EU is mixed, and US we have to see. So those are the big drivers. Those are the things we're watching. Somebody asked me on Capex, in a world full of, say, 30% EVs by 2040, the total Capex we've estimated, and you and I can actually do it back of the envelope, the total Capex needed, charging infrastructure, gigafactories, name it, showrooms, you add up to about 600 billion, 700 billion. So it is a massive Capex number, even higher than the NASA space program adjusted for inflation. So it is a mega project, and we wanted to. So really, I'll stop it here. The investable themes are more, actually, we've written this more in the context of global investments. So I've done it, whether it's battery makers in Korea, Japan, or, MLPs in the US. So I'm going to skip the investment expressions, maybe not germane enough for this audience. I would rather save the extra time for questions, both on near-term oil. Everything is fair game, both on near-term oil and oil projections. So actually, I'm ready to take questions sooner rather than later. Thank you.
Thank you so much, Dr. Vasudevan. Let's have a round of applause for him. Yes, the app, we've been getting some questions, so please keep sending more questions on the app. Let's put up our first question that's come on the app for you, Dr. Vasudevan. It says, what is your view on the energy sector when it comes to electric mobility in the future? Will it have a material impact? So you did touch upon
Absolutely, absolutely. And I'll break it in 2 pieces. A stall in the rate of growth of gasoline, so refiners and refiners and marketers, that RMM premium, maybe not in India, which still won't be that high in EV penetration, the whole huge thrust or multiples that retailers get starts to go away. And our own big sectoral call we've discussed with our investors is power sector starts to look interesting again. Look, if you saw US, we had a multi-decade bear sector, right, in power consumption. You look at the IPP stocks, they're all starting to look much more interesting now. So yes, in fact, there are three ways in which it affects the energy sector. Again, I'll use it broadly. The smartphone model will beat the filling station model. That is the power sector. The power sector will continue to do well, and it potentially will outperform the refining and marketing sector. That's one. The second one is, yes, gasoline demand will stall for this decade, which affects S&D balances, but more importantly, will start to plummet in the 30s. So yes, I think it's a mega impact on the energy sector and the relative preference between what I call the oil refining model versus the electric power producer and utility model.
So I had a thought, and you're the expert, of course, but over the years, so in the 70s when the Middle East oil producing countries raised prices, everything was going crazy. So India obviously is very dependent on that oil price movement. For the way ahead, while we're seeing electric mobility picking up, I think that China is one of the ones that is building the lithium batteries.
Exactly, a whole range of batteries.
Do you foresee a future where, again, the world economy will be kind of based on China? So if China decides to raise the price of lithium, everything else will get impacted. And I'm talking, of course, way ahead in the future when electric mobility becomes more common.
Yeah, in fact, I'll answer your question and diverge a little bit into history where the perspective is extremely important.
Please.
See, lithium is just one piece of it. And to be clear, yes, China has a lot of lithium resources. You know what Tianqi lithium and everyone is doing in Tibet and elsewhere. But there's plenty of lithium also, as you know, in Latin America and the salars, right, and the salt lakes, whether it's Chile, whether it's the neighboring LATAM countries to Chile. So, and also lithium is recyclable.
Right,
in fact, the message to learn from China, as I tell anybody in the EV business, just visit the city of Wuxi in China, right, and look at what they're doing from the manufacturing, from the recycling. It is amazing. So I'm actually hoping that other countries copy that recycling model.
That's the important
That's
point.
extremely important. No battery goes waste, nothing goes waste. The level of recycling is very impressive. That's one. The second thing is, look, history could have been very different. It was one person who changed it. Remember, in 1880s, I'll show you a photo if you have some time after this. There was already an electric car, by the way. And in fact, Ford himself did not know at that time which will win, right? He had a joint venture with Thomas Edison.
Right.
Look at both alternatives, right? These cars were also inefficient. But Charles Kettering invented the self-starter. Right. That's what caused the game to end. If I was a betting man in 1880s itself, it was a toss-up. Right, because given the engine technology then and here, and I'm glad to send any of you the links. It's very important to know that history, that it was not a slam dunk, that EV was not in our picture an internal combustion engine one. Ford and Edison were collaborating back then itself, when it was not quite clear. But then the Ford Model T was a big success. Charles Kettering's self-starter more or less solved it in the favor of internal combustion engines back then.
Interesting. We have one more question from the audience. What is the impact of NPAs on the energy sector?
The US energy sector, I'm not an NCLT expert here, but I think you want to be actually asking me the reverse question. Pardon me, I'll be bold here. I think you might have possibly wanted to ask me the opposite. Right. What is the impact of the distressed coal power plants and elsewhere on the NPAs, right? Am I correct? I mean, I'll try and answer the questions. Look, we are global investors, but yes, we have looked at the India NPAs, NCLT, and correct me if I'm wrong, Bala sir, something like 40% of all of the NPAs that I could back of the envelope calculate was related to the power sector. Most of it, correct me if I'm wrong, was related to as simple as coal availability, right? Coal availability at plant, not necessarily at mine mouth. Right. Coordination between rake availability, the railways and coal. Yes, it's a big issue. I've looked at it, you're possibly closer to it, but to me, it seems very much an internal problem that is solvable genuinely, that's solvable between, should be solvable between the coal ministry, the rail ministry, and
Okay,
And that affects the NPAs as opposed to the other way around. So.
One last question. In view of the bearish outlook overall of the oil economy, what happens to the billions of dollars of investment made?
Very, very interesting question. I keep getting asked that. Well, I actually regret not going into starting an oil company in the Barnett Shale back in late 90s itself. So this is the nature of it, right? This is the nature of all investments in every mega cycle. But the point, though, is the investments made in oil economy are much more careful investments, unlike tech, right? I'll give you an example. I'm invested in master limited partnerships, in the oil and gas, in the oil and gas equity infrastructure. But it's the toll road model. So even if oil goes down by $10 to $15, 90 to 95% of the EBITDA is completely secure, right? So this is not like the last bull cycle. People, especially in the US, are now much more cautious in terms of managing the returns of the cycle. And you're absolutely right. In fact, it's not billions. If I'm not mistaken, it's trillions of dollars, right? You can come to but most of that money is actually even feasible at $55, $60 oil, right? And look at it, US, you ask me a Permian well, simple payback time is 2 years. So you have a rally in oil, people hedge 2 years. That's it, right? You got a simple payback already. So also don't underestimate the discipline in the industry. To be fair, E&Ps have really improved their short cycle economics, right? People have, you go back, take the financials of any US energy company, right? Pick any of them, right? Pick a BOG, Pioneer, name it, and look for the payback, simple payback time for a well. It's somewhere here between 18 months to 24 months.
So I think this next question that's came up during your earlier answer, and this is a perfect way to talk about supply and demand. So what is the cost of production of crude and what can really be the floor
very good
in terms
point.
of price?
See, the point is you must never think of supply and demand as static, right? That is the worst thing you can do and make mistakes in price. So when you talk about floor, let's define there are 3 levels of floor. There is one level where full cycle economics work. But if you really get into decartelization, it becomes the floor turns into a cap. Right? Because the market will trade, OPEC will signal, like 2014, prices had to go so low that the US rig counts had to go so low that Saudi was satisfied, and oil prices had to go so low that rubles got weak and you got a ROPEC, Saudi, Russia talking together, right? So remember, in a down cycle, the floor becomes the cap because the equilibrating mechanism in anything like an OPEC or anything that involves a cartel-like structure is for the other party to get to its knees. So that's the biggest mistake people make, right? So if you want, can I give you 2 answers? I will talk about normal state and depressive state.
Sure.
So in a normal state, where you're not decartelizing aggressively, right? So let's assume Saudi needs to continue to come to the bond market to fill the budget gap, more 10, 20 billion of Aramco bonds or equity. So in that situation, I think the floor will have to be at least mid-60s.
Right.
But in our situation, if there actually a decartelization pressure, Venezuela, Russia, either Venezuela against the ROPEC or you have that paradigm, the Monroe-PEC paradigm, then the market has to actually signal for the scare for the other party to come to the knees, right?
Right, of course.
That's the nature cartels work, right? I've lived through 97, 98. Then you have to go sub 50. At that point, when you're in the decartelization framework, the same 55 is not a floor, right? It's a cap because you need to go below that price to test the pain point for the market to equilibrate. So I keep replying, people think equilibrium, but oil markets should be modeled in a manic depressive framework, actually, literally. Right. What takes you to one regime versus the other regime.
Fantastic. Well, I think we have one last question, quick, just as we run out of time. What major sectoral disruptions in the economy do you foresee in the wake of EV mobility, and how should investors prepare for it?
Excellent question. So I'll break it into, again, 3 pieces. I think the ancillaries for the auto industry have to change. Again, I'm not a total expert in it, but think about it, right? An EV doesn't have the complicated powertrain, right? It's a battery and inverter and pieces. So the auto ancillaries you really have to worry about. I know a lot of European companies are much more exposed to it, say, than India or anywhere else. So in Europe, you see a lot of that. They are the people one should really worry about. equally, on the positive side, I still think power, IPP, power utilities, especially with access to customer, they could even monetize the cost of charges, the ability to JV. I think power producers and utilities are actually after, multi-decadal bear cycle in US, at least a decade bear cycle in India. Again, India is a different story. You might not get the same level of EV penetration, but even in China, you're going to see that switching happen. And renewables benefit, because when do you charge in night? And off-peak power, the biggest problem of wind has been, you're very cheap marginal cost, but you're generating at 3 a.m., 4 a.m. peak wind, where nobody needs the power. But in a smartphone model, right, if you can smooth out, and we've done some work on that, if you smooth out the diurnal patterns, the biggest relative beneficiary actually becomes renewables.